are joining us live from snowy Ithaca, New York, home to Cornell University. I'm Chris Wofford, and today we welcome Cornell Law's Chuck Whitehead in studio with us. Professor Whitehead brings an especially unique and informed perspective to today's discussion. And frankly, I learned so much just being in his general proximity. Chuck is co-author of the current version of the oldest and most widely used securities regulation casebook in the country. I should also note that Chuck is faculty author of Cornell's 4-course online certificate program in securities law, and we will share the URL for those who are curious about further education on the topic that we're going to be exploring today. A couple notes to our viewers. Welcome everyone from wherever you are joining us. This event is being recorded and will be viewable at the same URL afterward, right? So if you have to leave or you want to share the event with colleagues or friends, this is the URL to rejoin or view at a later time. We are very much interested in your questions in the chat, right? So you may open it by clicking the dialog box at the top right of your video player. Send the questions. I'll get them here on the iPad, and we'll take them as they come in. We're also going to be asking you a few poll questions. We've already gotten a start here, which you may launch by shooting the QR code with your smartphone. And again, throughout the discussion, we'll be sharing URLs and resources in this chat. So heads up for those. Just a few resources. There's a downloadable on Chuck's deck that you'll see shortly. It's in PDF format. So if you're watching the archived recording, we are live right now, but if you're watching at a later date from the original air date, those links that we're going to be sharing are available in the overview section below. So if you hear us mention something that a URL to be shared, you'll find it below at a later date. So for our first question, we're trying to get a sense of where our audience is joining us from, as we always do. We are asking you, audience members, where you're joining us from. So hopefully we can populate this particular question. It looks like Bosnia and Herzegovina is running away with this one. We've got people joining us from Ithaca, Chicago, Michigan, and otherwise. In the meantime, Chuck, welcome to the studio. Great to have you in.
Great, thanks very much. Great to be here. I see we have some from the Bahamas too. I should be on the Bahamas.
Oh yeah, the Bahamas is going to come up today in our conversation. Texas, Michigan, Philly. Thanks for joining. Chicago, Bosnia, Herzegovina. Anyway, so in short, what we will probably see is as this continues to populate, is we do invariably have an international audience. Topically, what we're covering mostly kind of concerns domestic regulations and laws as it relates to securities. So hopefully our friends from all over the world will be able to take something away from this as well, and I think that will be the case. Okay, let's close this one. Welcome to the show, Buenos Aires. Good to have you. Let's ask question number 2 here, which is, how familiar or knowledgeable are you about crypto assets and the legalities surrounding them? So there are 3 answers here. Trying to keep it simple. I am expert level, totally knowledgeable. Second choice, I know a little bit, but this is a difficult topic to follow. A lot of emergent developments in this space. And the third choice is, I know almost nothing, but I am here to learn. I'm somewhere between 2 and 3. I got to tell you. No, I'm at choice number 2. But like I said, I always learn a lot from Chuck.
It's crypto assets. I think we all know almost nothing. But,
yeah. All right. Yeah. We'll see as we go. So it looks like everybody has some familiarity with this, right? It's certainly hot in the news all the time, and I think as we increase exposure to this, people's understanding will continue to further. So there we go. 73% of us know a little bit about what's going on. In the meantime, Chuck, so let's go back to your experience. You bring unique experience and a particular qualification to our conversation today. Tell us a little bit about the work that you do at Cornell Law. And I should mention that before becoming a law professor, you were a banker. You were managing director at Salomon Brothers and Citigroup. You have a dense legal background. Tell us a little bit about the work that you do at Cornell and everything that preceded that.
Sure. So I was before becoming an academic, I was in the industry for about 20 years, both as a lawyer and later on as a banker, both in the States, in London, and Tokyo. I've been an academic since the early 2000s and just love being at Cornell. The work I do at Cornell has ranged from sort of my core work, which is law and finance, law and securities, mergers and acquisitions, corporate transactions. I'm also the originator of the Law and Technology program down at Cornell Tech. So spent a fair amount of time down at Cornell Tech and Roosevelt Island and so forth. So it's kind of transactional, corporate, legal type stuff with a little bit of a tech bent.
So what historically how have you been working in this crypto space? How long have you been involved in it?
So, putting crypto assets aside for a moment, just
Yeah.
talking generally about tech, tech and innovation involving technology has been part of the financial markets forever. In fact, if you think about it, Cornell University is, in fact, a fintech university. The Ezra Cornell was one of the founders of Western Union. And so there's a history of innovation and technology in tech, and so that's very much a part of what I did in practice. It's a part of what I do in the law school. In terms of crypto itself, I think initially I was looking at blockchain, which is the underlying technology involving crypto, but also became engaged more deeply with crypto when we were doing the Cornell Tech program. So that would have been, 8, 9, 10 years ago, something
Sure.
like that.
Got it. Okay. Great. Audience, again, we're going to be taking your questions, but let's kick off with a segment. This is a great explainer segment that'll kind of inform everything about our conversation going forward. You're going to be talking about the Howey test. What is the Howey test? Give us a little historical perspective and its applicability to what we're going to be talking about today.
Sure. Do you want me to go to the slides?
Yeah, let's go to slides.
Let's go to the slides first. So
Yeah.
we're going to talk a little bit about the Howey analysis. And I have to say, if you're in the crypto industry and if you're familiar with new technology, the Howey test kind of drives you a little nuts. And that's because the Howey analysis is based on a case from the mid-1940s. And what it does is it focuses on the definition of security. So if you look at the securities laws, there are two types of definitions in the securities laws. And this is, by the way, as much for the benefit of folks who are just getting familiar with this area. It's good to kind of have this background. It gives you a lot of sort of an understanding of why there's so much fighting at the regulatory level about who should be overseeing this industry. So you've got these very specific definitions of what a security is. It's a stock, it's a note, it's a bond. But you also have some catch-all provisions, like investment contract. And the reason the catch-all provisions are there is because back in 1933, 1934, the folks who were writing these definitions knew that there would be new types of instruments that should be regulated as securities, but they couldn't define them. So they had this catch-all language. And investment contract is really the phrase within the definition of security that people are focused on today. And it was interpreted initially in a case called Howey. It's the Howey analysis from, again, the mid-1940s. It's a Supreme Court case. It involved the sale of parcels of land down in Florida. What they were doing is they were focused on folks coming down from New York, cold Ithaca, New York, coming down. They would open up their hotel window, and there in front of them would be this beautiful citrus grove. And this affiliated group, the Howey Corporation, was looking to sell interests in parcels of land in the citrus grove. But there were a couple of conditions. First, you could not actually go onto the land itself. Now, that didn't matter if you're just visiting Florida. So you're not interested in going on the land. You weren't consuming oranges, right? You weren't going and buying parcels of land to pick oranges. In fact, again, you weren't allowed onto the land itself. Instead, you had to hire someone, a servicer. They were recommending a company called Howey in the Hills. It was a service company that would grow and harvest and sell the oranges. And ultimately, at the end of the day, your interest was really just to get a financial return. That once the oranges were harvested and sold, you would get whatever the profits were, the sales proceeds minus the cost of raising the oranges. And the question was whether or not, even though it was packaged as a sale of real property, this might not, in fact, be a financial instrument, something that looks like a security. And so the Howey analysis adopted a test in deciding whether or not something is an investment contract and therefore subject to the federal securities laws. First, is there an investment of money? Whoops, sorry, I jumped ahead. First, is there an investment of money? And the answer was yes in the case of Howey. Was there a common enterprise? Well, yes, they were all dependent upon how well the orange grove did. Was there an expectation of profit? Yes, right? They were going to get a financial return. They weren't going to consume oranges, predominantly based on the efforts of others, the people that were out there harvesting the oranges and selling them. Now, over time, this particular analysis got adopted by, later courts. It was a Supreme Court case, of course, but they applied it in different contexts. One case was Gary Plastics. Gary Plastics involved Merrill Lynch, the broker-dealer, selling interests in certificates of deposit. Now, CDs are not securities. They are bank deposits. But what Merrill Lynch was doing was assessing the quality, the credit quality of the banks, and perhaps most importantly, they were monitoring the CDs and creating a secondary market in the CDs. And so even though the CDs themselves were not securities, they are just, bank assets, bank deposits, the question was whether or not the totality of this package might be a security under the Howey analysis. Okay, so in the case of the Merrill Lynch, the Gary Plastics program, was there an investment of money? Yes. Was there a common enterprise? Well, yes, they were all together working as part of this Merrill Lynch program in deciding what CDs to invest in, again, relying upon Merrill Lynch to create a market in these CDs. If they wanted to sell them, you could sell them through Merrill Lynch. Was there an expectation of profit? Yes, you were investing to get some money, and it was based on the efforts of Merrill Lynch, right? The efforts of Merrill Lynch in terms of selecting good CDs to invest in, but most importantly, creating that secondary market for the buying and selling of CDs. And so what Gary Plastics told us was that even though the instrument itself may or may not be a security, the totality of the relationship, right? In the case of Merrill Lynch, the fact that they're creating a market, the fact that they are doing other services, the totality of the relationship is what mattered in deciding whether or not a security was being sold. So let's apply this to NFTs, right? Non-fungible tokens. A fractional NFT. Now, as many of you know, this is a type of a crypto asset. And at its most basic, it just gives you an ownership interest in something else, an underlying asset, perhaps a painting. So let's say there's a fractional NFT, and it gives you an interest in a painting. It's a digital certificate of authenticity, says that you own, let's say, 1/10, 1/100th of a particular painting. There's no operating business. There are no royalties being paid. Is there an investment of money? Absolutely, right? You're investing to get that 1/100th interest in the painting. Is there a common enterprise? Well, yes. You and the other 99 investors are the ones who are investing to be able to get this painting, right? Collectively, you own 100% of the painting. But is there an expectation of profit, and is it based on the efforts of others? Well, no, not in this case. I'm simply looking to buy a painting. I am consuming the painting, if you will, right? I'm getting an interest in the painting so that I can say I own part of the painting. I'm not doing it for profit purposes, and it's not based on the efforts of others. So in this instance, these fractional NFTs would not be a security. Let's vary it up. Let's assume that instead, the NFT is being sold to me so that I can resell it at some future point and make some money. In that case, I've invested with an expectation of profit. But if the decision on whether or not to sell is tied to the approval of the holders of the NFTs, in other words, they're the ones who decide whether or not to sell, it's hard to argue it's based on the efforts of others, right? I'm the one who decides whether or not to sell, or 51% of the investors decide whether or not to sell. And so the decision of whether to sell, what price to sell out, what profits, is tied to the 51%, not on someone else. And so, again, on this basis, perhaps not a security. Instead, we decide to rely upon some sort of a manager who goes out there to sell these particular assets. We trust them to do it, or this manager creates a secondary market, much like Merrill Lynch did for CDs. In that case, the value is predominantly based on the efforts of others. We're relying upon the manager to sell. We're relying upon the promoter to create a secondary market in the securities. And so in this instance, you would satisfy the Howey analysis, again, not because of the asset itself. Fractional NFTs in and of themselves, not a security, but looking at the totality of the circumstance, you would understand this to be packaged as a security and so subject to the federal securities laws. Good so far?
Yeah, I'm right there with you.
Okay, so let's talk about what happened about 3, 4, 5 years ago. Created a little bit of confusion. This was a speech given by the then director of the SEC's Division of Corporation Finance, and he's talking about digital asset transactions. And he starts off by saying digital asset is simply code, right? In other words, it's not in and of itself inherently a security. It's just computer code, just like an NFT inherently isn't a security. You wouldn't consider that in the case of a digital asset. But the way it is sold, the packaging, is what potentially subjects it to the federal securities laws. Okay, so far so good. This is what we've been talking about in understanding the securities analysis. And to the extent that you are, again, packaging this as a security, there's a benefit to having the federal securities laws involved, the disclosure, the information necessary to decide whether or not to make an investment. Now, what Mr. Hinman then is he went on to talk about the application of this analysis to digital assets. And the point he makes here is that at some point, where you have a decentralized trading network, at some point you no longer really are dependent on the efforts of others. Think of it like gold or silver bars, right? To the extent these things are selling in the marketplace, their market demand, it goes up and down. The marketplace has more or greater interest in buying or selling gold. There you're not dependent on the efforts of others. It's the market that's driving value. And at some point, Mr. Hinman suggests this is also going to be true with crypto assets. And so what he suggests is that the network on which Bitcoin and Ether are built are decentralized, and because they are decentralized, it's a decentralized technology. These things on balance are likely not to be securities. And so in 2018, the view was, although, again, Mr. Hinman was simply a director, he's a staff director, he wasn't a commissioner at the SEC, the view was that maybe on balance the SEC would find these types of instruments not to be a security. The question is whether or not, when we're talking about decentralization and not relying upon others, we're talking about technology or we're talking about economics. And I would suggest to you that the Howey analysis is focused more on economic decentralization. In other words, you're not reliant upon someone else in creating value. The reason that's relevant is if you look at Bitcoin, you'll notice that there's a fair amount of concentration economically in a small number of wallets. Less than 0.5% of wallets control more than 80% of Bitcoin. And there are other studies that suggest as well that cryptocurrency is tied very tightly to a smaller group of people that tend to own the bulk of that crypto asset. And so the question then is, again, if we're focused on decentralization, if we're focused on this absence of reliance on a third party, are we focused on the technology where, in the case of crypto assets, it really is a decentralized technology, or are we focused on the economy? And to the extent that the economy, the economic centralization, is what drives Howey, that would suggest to us that the common enterprise might exist even in the case of Bitcoin. The expectation of profit, again, tied to the efforts of others, that small group of people that may be promoting Bitcoin, who may be a necessary part of creating value in Bitcoin by creating a market in Bitcoin. These are all things that you take into account in deciding, like we saw with Gary Plastic, whether or not this might in fact still be a security. So the key point here is that to the extent holdings are concentrated, to the extent the value of Bitcoin is based on the efforts of a small group that have a direct stake in the economics, the outcome, perhaps in that instance, it's very fact intensive, perhaps in that instance we should think of some of these crypto assets, including Bitcoin or Ether, as being a security. The problem, of course, is this can flip-flop over time. It may be centralized now, it may be decentralized in the future. And that creates issues because to the extent that it's a security, there is a whole range of regulation around the buying, the selling, the custody of these types of instruments. You're regulating the intermediaries, you're regulating against fraud that the Securities and Exchange Commission and state regulators can bring. To the extent that this changes over time, it means that as an investor, you might have the protections today, but you might not have those protections 2 years from now. It will depend upon the particular situation involving the transaction, the particular crypto asset you hold, which suggests perhaps that there is a need for a special category for crypto assets. I mean, to the extent we're worried about protecting investors, giving them the full benefit of the securities laws, this idea that over a 1 or 2 or 5 year period, something can become less of a security without it being entirely clear where that line is between being a security and not being a security, that suggests perhaps we need to rethink the way in which we regulate crypto assets, even taking into account the Howey analysis. And that's kind of the very, very quick, basic background. I hope that's useful.
I think it will be useful. Let's go a little more high level and think about the overall landscape. In the U.S., there are several regulatory bodies overseeing crypto assets. There's the Federal Trade Commission, the FTC, Commodity Futures Trading Commission, the CFTC, the U.S. Securities and Exchange Commission, the SEC, banking authorities, state authorities, all handling various regulatory duties. I see what you're rolling your eyes. Does this make sense? And if not, why? What are the issues we're dealing with?
So it's referred to as the regulatory alphabet here in the United States.
Got it.
SEC, CFTC, OCC, CFPB, and so forth and so on.
Yeah.
And this is largely historical. It's a reflection of the way in which we think sort of historically about how to regulate the industry. Banks are regulated by banking regulators because they happen to, do a certain type of business. The SEC regulates broker-dealers and securities exchanges because they do a distinct, separate type of business. The CFTC deals with commodity futures and other types of derivatives, again, because of this very distinct type of business. The problem is that over time, these historical distinctions have fallen away. What may or may not be a banking practice can now pop up in the securities industry. What may or may not be a security can pop up in the area that the CFTC has oversight over. And that's the big problem, is that the way we think about regulation and the way we think about the industry has changed over time, largely reflecting the fact that there's been innovation in the industry itself. And so, if anything, crypto is highlighting a fundamental flaw with the U.S. approach to financial regulation, which is that we don't have a central regulator. In fact, if you look down at what's happening in Washington with debates over regulation, I don't think there's any question that everyone knows what needs to be regulated. I don't think there's any doubt in anyone's mind that there needs to be a focus on anti-fraud, there needs to be a focus on protecting consumers, and so forth. The real debate is on who is going to be doing this. And again, that ties back into the fact that we have this alphabet of regulators around the United States. On balance, I would suggest it's the SEC. We can talk about that some more. But the point here is that not having a central regulator, it creates exactly the kind of difficulties, right? Are crypto assets a security or not should be less relevant than whether crypto assets should get the full protection of whatever the laws happen to be dealing with crypto assets. But we have to focus on this kind of a characterization because it goes to jurisdiction. It goes to whether it's the SEC or somebody else. And that, I would suggest, is kind of a problem today.
Right. So once again, the SEC, the question is about the classification of cryptocurrency as either being a commodity or a security, right? I mean, that's ultimately what this was about. And you had said before that the SEC is uniquely positioned to, to oversee this. For what reasons?
So the SEC is a consumer financial regulator. They are their fundamental goal is to protect consumers. I know we don't necessarily think of them this way.
No.
We think of them like, Goldman Sachs and Merrill Lynch and so forth. But their fundamental remit is to protect investors. They were set up really with a view towards protecting mom and dad, retail investors. Now, retail investors are perhaps less in the market today than in the past, but again, that's their DNA. That's the way they think about this. And so the regulations that the SEC has in regulating broker-dealers and exchanges and people that take custody of these assets, these are the kinds of things that were intended to protect investors against the sorts of things that you see with FTX and the blow-ups and people losing money and the scams that are out there right now. So they're really set up to do this. The CFTC is an excellent organization. They don't regulate commodities. It's a common misperception that they regulate commodities. Commodities, meaning the buying and selling of gold, is actually largely unregulated. They're regulating commodities futures. These derivatives, these future deliveries. And again, they also have a strong regulatory network, but their focus tends to be a little bit more on anti-fraud type issues, certainly as they relate to commodities. And so as between the two, I would suggest the SEC already has a toolkit. And so it makes sense for the SEC to pick this up. In fact, I think the Howey analysis covers a large part of what the SEC would be thinking about in deciding jurisdiction. Subject to that point I made at the end, right? Which is that at some point, some of these assets may go from being a security to something less than a security, and that can be problematic if you're trying to protect investors, make sure they understand the nature of what it is they're buying.
And now we find ourselves moving toward improprieties. And the question on everyone's mind is it appropriate for Kim Kardashian to be investigated or brought in or charged with selling accounts tied to crypto assets? This is not a unique phenomenon for Kim Kardashian, right? There are other celebrities that are kind of embroiled in this. What's going on with this?
I stay awake at night worrying about Kim Kardashian.
I know you do.
It's a tough thing. But more Tom Brady is being picked up as well.
Yes, right.
So the key point here is that crypto it's not sneakers, right? It's not a perfume line. It is a financial instrument. And because it is a financial instrument, it is also susceptible to the kinds of fraud and manipulation that, can happen with financial instruments. And so there are rules that deal with how one goes about promoting these instruments, both at the federal level and at the state level. So Florida, for example, has a very muscular rule that deals with people who are promoting investments into securities without disclosing that they're being paid to do this. And that's the key point, right? If Kim Kardashian or Tom Brady wants to talk about crypto at large, anyone can do this. To the extent they're getting paid to do this and they're not disclosing that payment, it raises real issues. Just like it would if I was looking to sell stock, right? If I wanted to sell stock in Whitehead Co., don't buy. If I wanted to sell stock in Whitehead Co., or if you were selling stock in Whitehead Co., and you were out there promoting it, you would expect to be responsible for the fact that you are promoting this investment, just like Kim Kardashian should be responsible for promoting these financial instruments. And so, yes, it's something that, it strikes you as a little odd to think about Kim Kardashian promoting a security, but or for that matter, an investment asset, but that's really what she and others were doing when they were focused on crypto. And the rules dealing with how one goes about doing this, it's intended to avoid conflicts of interest, right? You don't want people being paid to, promote these assets and not describe what it is they're doing and the nature of their relationship.
Yeah.
To the extent you're not doing this, it would make sense from a financial perspective for them to be liable. And that's why the Kims and the Toms and the others are being picked up, both private litigation as well as regulators who are going after them for not having made these disclosures.
Thanks for the clarity on that one. Questions are coming in. Viewer Dana asks, I'd like to hear your thoughts on whether crypto is more like a currency than a security. It seems like that is how it's being used or advertised. Why not categorize it that way?
So
what's Dana getting at?
Yeah, great question, Dana. Thank you. So it goes again to the nature of how you think about the asset itself. If I think if I was taking crypto and going and buying a sandwich with it, that would look much more like a currency. And so to that extent, you would argue, well, that is something that really doesn't need the protections of the securities laws. In fact, there is a bill, as you may be aware, that is coming up through Congress. And the bill is it's the Digital Commodity Consumer Protection Act, DCCPA, where in fact they talk about this, right? You carve out the use of crypto from any sort of regulation where you in fact use it as a currency to go out and buy a sandwich. And that makes a lot of sense. To the extent that it's being used as a way to promote investment, it begins to look a lot more like a security. So if I come to you and say, buy this orange, going back to the Howey analysis, or buy this digital asset, not for consumption, not to go out and buy that sandwich, not to go out and to be used as part of commerce, but rather because I'm creating a secondary market in this. And lots of people will be interested, and I'm going to promote it, and we're going to get Kim Kardashian and others involved, and this thing is going to go up into value. That looks a lot more like a security to me. And so the concerns are not with crypto in and of itself or crypto as a currency to the extent that crypto is accepted in terms of, buying a sandwich. There are a lot of cases actually where crypto is being used for consumption. In fact, the SEC has issued no action letters. There was a company called Pocketful of Quarters, as I recall, where you would invest into crypto and you could then use this crypto to buy video game time, online video game time, and that was clearly much more like a currency. That shouldn't be a security. There was no trading in those assets. There was no use beyond going out and simply buying that usage of the video game. But to the extent that you're out there promoting this as an investment, and that's a large part of this industry, buy in, make a lot of money, we'll trade the asset, that to me begins to look a lot more like a security, and that's where the SEC is really good at regulating the marketplace.
A lot of SEC-focused questions. Max chimes in and asks, what do you think of the SEC and Gensler's approach to the matter? In the end, the reality is that with tests so flexible as Howey, how a regulator approaches a matter is even more important than the test itself. You know what Max is driving at here?
Yeah, so it's perhaps a reflection on Gary Gensler's background, and he clearly has a capability in this area, right? He has a familiarity with the CFTC. He was at the CFTC before the SEC. In fact, he was teaching classes on crypto before he joined the SEC. So he certainly knows the area. And he's made it very clear that this was a primary focus for him and the staff. And that includes the enforcement arm of the staff. But keep in mind, right, the SEC is a regulator. They are not the final deciders as to what the law is. That's ultimately the court system. Now, that's not to say that it's inexpensive and not costly and not a pain to get the SEC knocking on your door and creating problems for you. In my experience, and I know there's been some public chatter in some of the blogs and Twitter and so forth about the SEC not necessarily being user-friendly. But in my experience, they are quite user-friendly. If you go and talk to them about what it is you're doing and you ask them for some guidance on whether or not this or that is or isn't a security, they will give you that guidance, even informally. You might ultimately look to get something formally in writing, but they'll give you that guidance to the extent you can't make the determination yourself. So yes, like any regulator, the SEC is going to be driven by where the commissioners are thinking about this. But at the same time, to the extent that you think they're off base, there are arguments that can be made. I don't view them as a closed staff. In fact, it's a very professional staff at the SEC. Mm-hmm. And really, ultimately, you can always go to the courts if you really think that the position that's being taken is an off-base position. I think the cases that I've seen and the ones that I'm most familiar with involve just out-and-out frauds. I don't think there's any ambiguity as to whether or not something is or isn't a security. And so, yes, Howie has some ambiguity to it. To be clear, this is quite deliberate. I don't want people to think that this is some sort of a fallacy with the law, mm-hmm. right? Ambiguity is, in a way, a good thing from a regulatory perspective because you don't want people knowing that, well, if I do A, B, and C, I'm a security. If I'm A, B, and C prime, I'm not, right? Because everyone will try to economically do A, B, and C, but do A, B, and C prime to get around the regulations. And so there's a certain flexibility in there. It's built into the statute. But at the same time, there are limits to this. And so, yes, I take the point that the regulator drives the analysis. We saw this with Mr. Hinman describing his views that I don't think are necessarily shared by the SEC today. I would also argue that Mr. Hinman's views perhaps weren't quite accurate when he expressed them. But I also think that going forward, if there are open issues, they can be addressed with the staff. Mm-hmm. And again, ultimately, if it really comes to it, addressed with the courts.
Perfect. Great question, Max. We're going to keep rolling with these viewer questions. They're coming in, and they're very good. WJ asks, cryptoassets are used, this comment, cryptoassets are used primarily as speculative investments, which is not in line with the stated vision of most projects out there today. How should the regulators navigate this? What is WJ driving at here?
So thanks, WJ. I feel like the Dear Abby person.
I know. I know. We're doing it.
Okay. So thanks, WJ. What you're highlighting is kind of a fundamental tension, I would suggest, in the crypto space. Right. The whole rationale behind crypto assets was decentralization and a way to create a non-centralized, non-government controlled medium of exchange across multiple parties. And so the vision was that it would provide banking attributes without necessarily having to have a bank. That you'd be able to use crypto assets as a means to support parts of the community that otherwise were not being properly supported by the financial industry. And that's largely not been the case. In fact, you can argue that in some cases we're taking advantage, or people that are raising crypto or pursuing crypto deals are taking advantage of the folks that crypto, at least initially, was intended to support. And it's being done in a centralized way. So in kind of the original thought of crypto is kind of being turned inside out. You're seeing clumpiness, right? People are having to trade crypto through an exchange as opposed directly with each other. They are holding crypto in accounts that are maintained by folks who are either affiliated with or brokers tied to the exchange, again, as opposed to the sort of decentralized approach, with the assets being raised very often targeting people that are less sophisticated, again, those who are supposed to benefit from crypto. This is exactly why I think the SEC, which is focused on this sort of a potential investment process or investment weakness, why it makes a lot of sense for them to get involved. At some point, there will come a time, perhaps, maybe in my lifetime, maybe not, where the crypto will begin to look more like a commodity, from the earlier question, more like a currency. And in that case, the need for regulation drops away. We're just not there now. And that suggests to me that there should be a regulator. Whether it's the SEC or somebody else, there should be a regulator focused on consumer protection, precisely because of the scams, WJ, you're referring to.
Perfect. Another really good one comes in from Jen here. Again, this is about jurisdiction and who should be overseeing this. And I think very shortly, I think we're going to get into fraud and some of the darker corners of this. But for the moment, let's talk about regulatory oversight. So there's been comments in DC, Jen says, that the commodities regulator is probably more suitable to regulate crypto assets than SEC, as it's more proactive. Can you please comment on why CFTC is more proactive as a regulator than SEC? There's a presumption in there. Is there an official conclusion on the nature of crypto assets now, security or not?
So that's two questions.
And it's maybe three.
No,
right.
and thank you. And who was that from?
Jen.
Jen. Hi, Jen. So I don't know about the proactivity. I think part of this is a reflection of just the nature of the regulatory infrastructure. Again, the SEC, just given what their mandate is, and given the way the securities laws are set up, is more sort of hands-on and directly involved in the industry. And so as a result, if you're going to be in the industry, the securities industry, it means that you spend a lot more time working with regulation and working with the regulators, which can be problematic if you're a startup. It can be problematic for any startup, crypto or not, because you are dealing with regulators that may not be as familiar with what it is you're trying to develop as you and others in the industry are. The reason I think the CFTC is somewhat viewed more positively is because, remember, they don't really regulate commodities. They regulate commodity futures. And so if you try to equate crypto with a commodity, like a currency, that was what somebody else earlier was suggesting, they're going to be more hands-off because their focus is going to be on more anti-fraud type issues as opposed to direct regulation of the industry. The DCAAP, the Digital Commodity Consumer Protection Act, DCCPA, that bill that I mentioned a few moments ago, that does look to give the CFTC more of an SEC type oversight over digital assets. In other words, they're going to regulate the various platforms, brokers, dealers, custodians, exchanges for crypto. It's very broadly drafted, and the CFTC has a lot of room for regulation. It's also not clear the way the bill is drafted to what extent they're coming into SEC jurisdiction. Securities are expressly carved out of the CFTC's jurisdiction in this proposal. So it doesn't really address this ambiguity between the SEC and the CFTC. But in light of the way that that bill has been drafted, and assuming it goes forward, right? It's still a bill. It's not yet the law. There's a lot of room for change. The CFTC would step in and provide much of the same kinds of oversight that the SEC does currently in the securities market, but now relating to digital assets. And so I can't speak to the perception you're describing. Again, in my experience, the SEC has always been very, very user-friendly and quite easy to work with. But I think part of it may simply be the differences in regulation that at least up until this point, people have perceived in looking at digital assets, and again, whether they're commodities or whether or not they are securities. What was the second part of the question?
Oh, gosh. Sorry. Scrolling around here. Let's see if Jen's question, it may have disappeared, golly. We're trying to manage the question.
Yeah, sorry
so we took it out of the queue. I apologize.
Sorry about that, Jen. It was a good question. I was so taken by it. I just can't recall the second part of it. But I think the bottom line here.
Security or not.
Security or not?
Yeah.
So I think the SEC is pretty clear that most of the stuff out there. I think Mr. Gensler has said that 80-90% of what he's seen in the crypto space are securities.
Yeah.
Again, there are these exceptions, like the pocket full of quarters example I gave you.
Mm-hmm.
But certainly, as far as the SEC is concerned, and based on what I've seen as well, the vast majority of these crypto assets, given the way in which the assets are being used to raise funding, right? That's the key point. It's the Merrill Lynch example, the Gary Plastics example. That suggests to me that yes, yes, these things are subject to the securities laws.
Thank you, Jen. Nice one. A big dimension to this is the fact, and this is kind of one of the through lines here, which is the technological innovation law is unable to keep pace with that, right? And what that creates is an environment with increasing potential for fraud, kind of like what we saw with Sam Bankman-Fried, founder and CEO of the cryptocurrency exchange, FTX. So
Alleged.
I apologize. Yep. What's going on in the wake of this seismic event? How are we thinking about it now? Right, we're a few weeks out.
Yeah. So FTX, of course, is a huge blow to the integrity of the industry, just because Mr. Bankman-Fried and FTX were viewed as being so clean, right? This was the safe place in which you could do trading activity. The other part of this to sort of keep in mind is it was done offshore, right? It's done in the Bahamas, and so it was being done away from the direct regulatory oversight that you might otherwise see if they were located, let's say, in New York. A large number, at least based on what I've read in the press and from what I've heard from others, a large part of what was happening there would have been either prohibited or regulated were we to treat these underlying instruments as securities. This would have been a securities exchange, right, FTX. To the extent that there were brokers involved, they would be regulated as broker-dealers. To the extent that there was custody involved, there are specific rules that deal with the holding of customer assets. And so this idea that I could take crypto or cash or something and invest it through an affiliate or invest it into other companies without the customers knowing is something that the securities laws would block. And so the one takeaway I think from this is that the SEC actually has the tools. A large part of what I've seen would have been picked up had the SEC had direct oversight. But because it was in the Bahamas, it was difficult for the SEC to do this. That's not necessarily a good excuse. And I think perhaps there needs to be a real focus on what the SEC should be doing going forward. But the SEC does, in fact, have the tools in place to handle a large part of this. Going back to the earlier question from Jen, and that argues in my mind to not setting up a new process through this bill that's passing through Congress that brings the CFTC in. Not that I have anything against the CFTC, but because we already have the infrastructure in place with the SEC, I think the key point here is that the SEC now needs to enforce this, right? Needs to go forward. So clearly that's part of the FTX debacle, right? The realization that we have procedures and regulations and review processes in place that for whatever reason weren't done, and so as a result you did not get the full protection that folks legitimately thought they had. Secondly, it tells you that you can't trust the markets to police themselves. This is a common view, that the market will police itself, that if there had been a problem with FTX, it would have been uncovered much earlier because the market or participants in the market would have seen this. I cannot tell you how many times in my career people have said this. And very often, typically, particularly in an enthusiastic market like crypto, you don't see that type of oversight, that type of critical oversight that you want to see from a regulator. Thirdly, perhaps, that bill that I mentioned to you, the digital commodity bill, that was actually being pushed probably most heavily by FTX and Mr. Bankman-Fried. And so you can imagine the wind has been taken out of the sails a bit on this. And it's not entirely clear to what extent that bill will go forward, as opposed to, again, what I think is perhaps the smarter approach, which is to reinforce and direct the SEC to very quickly get their arms around this space. So I think it's brought a lot of attention. You can imagine this is not true just at the federal level, it's true at the state level as well. And this is all a good thing for the industry. The question is going to be now, can we take the crisis and the, quote, benefits of the crisis and turn them into a way that makes this market safer for folks? Right,
and that kind of ties into what Tyler kind of chimes in, which is crypto's reputation, kind of ruined, right? Will the industry be able to recover for something like this? There's more to this story. Yeah.
Markets have incredibly short-term memories.
Yeah. Yeah.
So, is crypto ruined today? Not even so much. I mean, Bitcoin has turned the corner. Just this morning, I was listening to a couple of podcasts about how the crypto winter is over, and we're now moving into springtime.
Okay.
What I would mention, though, is this. The industry generally doesn't like regulation, and I understand why. I mean, who wants to be in a room with a bunch of lawyers? I can say this.
Yeah.
But the point is as expensive and as difficult as regulation can be, it also provides a positive to the industry itself, going to reputation, right? I'm a lot more comfortable investing in stocks because I know the market's regulated. And I know there are guys out there that are going to stay on top of, hopefully, the regulated players. It's not to say there aren't scandals. It's not to say that another FTX isn't going to happen again. I mean, just think, about the scandals that have come up in the securities industry. But it gives me a lot more comfort. And so I would suggest to those of you who are in the crypto industry or have friends in the crypto industry, regulation is a good thing. More importantly, be the first to be regulated. That will actually give you more credibility vis-a-vis your peers because, again, there's a certain value to folks knowing that you have regulators who are overseeing what you're doing and not relying simply upon the market to police itself.
All right, I think we're going to drift a little bit outside of your purview. You tell me if this one doesn't fit, but I like this question.
Okay.
MM chimes in and asks, any thoughts on how to determine an insurable need on life insurance applications for the purpose of buy, sell, or shareholder protection for such a volatile and unregulated industry?
An insurable need. So you're asking whether or not there's an insurance process? Is that what they're asking here?
I don't know,
yeah. Can you buy insurance on assets? The answer, of course, is yes.
Okay.
The question is not whether or not you can buy insurance. The question is the price at which it's going to cost you to buy that insurance. The other question, of course, is going to be the nature of the coverage of that insurance. So, is there insurance for lots of things that relate to assets? I mean, I would take a step back and suggest that your best insurance, if you're going to be in the crypto asset business, is diversification of your portfolio in the first instance. And not putting all your eggs in a single basket, and perhaps looking at crypto as part of a broader investment portfolio, right? Crypto shouldn't be 100% of your portfolio. It should be 5% maybe 10%, whatever the number is. The point is that just you don't need to necessarily have third-party insurance to cover whatever it is you're doing. The focus should be more on self-insurance, if you will, by managing the risks through portfolio diversification. But were you to try to find insurance, sure, right? Why not? I mean, there are bespoke insurance writers all over the world. I just don't know what the cost would be.
Whether it's SBF, WJ, MM, people using their initials seems to be a thing. I don't know if that's the way this crowd rolls. But JLS asks, what is the role of state regulators versus federal regulation? We haven't really talked about
Oh, excellent.
Yeah.
Well, so as a general rule, when you're looking at anti-fraud type issues, you're going to have both the federal and the states involved. So if you go way back to the early 2000s, there were, this was at a time when research reports were biased, and it's pretty clear there were conflicts of interest that were causing these research reports coming out of the big firms to be quite biased. The initial push to regulate and to bring people to account was actually done at the state level. It was New York State and 49 others, with the SEC later on jumping in. So for anti-fraud, there's an active role. I mentioned Kim Kardashian. In fact, there are both state as well as federal claims potentially that are involved here. But the big lawsuit that I've heard about is actually arising under Florida law, the Florida Securities regulations. It's a private lawsuit, but there's nothing to stop the regulator from stepping in as well. Now, in terms of the other aspects of the securities laws, overseeing the broker-dealers, overseeing the exchanges, overseeing the offer and sale and the disclosure. The way the securities laws work now, in most cases, this is going to be preempted at the federal level. So to the extent that the SEC does have oversight, you don't need to worry about 50 other states that have their own different qualifications getting in the way of what you're doing. And that's important if you are crypto, because crypto is ubiquitous. And so if I sell it in New York, I'm selling it in New Mexico as well, just because it's on the internet. But to the extent that it is overseen by the SEC, you're going to be taken out of the state level oversight, again, except for anti-fraud. But that's an important, that's a, look, if you're going to engage in fraud, you should have 50 regulators coming after you, in my humble opinion.
Yes.
And so in that respect, it's a good balance, right? You've got the states involved for anti-fraud, protecting their citizens. You've got the federal government looking at the broader marketplace and the participants in the marketplace.
Max comes busting back into the conversation with a case review question. In SEC versus Ripple, Ripple's lawyers, do you know this case?
I know the case, yeah.
Ripple's lawyers make a smart distinction between the contract, theme, and transaction of the test and the 4 prongs. What are the 4 prongs? Anyway, what do you think?
The 4 prongs were what we just went through.
Okay.
Yeah, I don't recall the particular argument they're making. I'm familiar with the case, but I don't know the particular argument. I will say this, though, about a lot of these arguments. So the theme that you will sometimes hear, and again, I just don't know what exactly the Ripple lawyers were speaking to, is that, well, these things can't be securities because there are no issuers. And that, the SEC's regulatory approach is on transactions, but it's transactions of securities, and one thinks of a security as having some sort of a legal something or other in the middle of it, an entity, a person, or whatever it is, that acts as an issuer. And I would suggest that's an incorrect understanding of the way people think about the markets. Probably even more incorrect today than it was 50 years ago. When people are trading, you're focused less on whether there's a legal entity that happens to be at the center and more on the nature of the investment being made itself. And in fact, right, think about Howey, right? I was buying a parcel of land. I wasn't buying an interest in Howey Corporation. I was buying the right to receive an economic return tied to some dirt down in Florida. So I don't know that this focus on issuer or entity or some sort of single group makes a lot of sense. And again, I don't know if that's what the Ripple lawyers were arguing, but I certainly have seen that kind of an argument in light of what you're focusing on, the 4 parts of the Howey analysis. The key point today is that people tend to focus, again, less on the entity and more on the nature of the potential of the particular investment opportunity that's being made. And in other words, I can say to you, hey, here's this great thing, whatever it is. It's going to make a lot of money for you. I'm going to help you make that money, but it's not tied to any one legal entity. There's no issuer involved. That, again, strikes me as the kind of thing you'd want to regulate. You'd want to regulate it because it's a financial asset and it's being sold as a way to make money. And so you'd want the sort of disclosures that the SEC focuses on so that investors could properly assess the nature of what it is they're being asked to put their money into. So again, I apologize if it's different from what you were focused on, but I don't know the specific argument that you're citing to in the Ripple case.
Cheers, Max. Thank you for that one. As of August 2022, WhiteHouseGov tells us that the estimates of the total global electricity usage for crypto assets are between 120 and 240 billion kilowatt hours per year.
As much electricity as Argentina.
Exactly, and Australia, right? So exceeds the total annual electric usage of those 2 countries and presumably many others. This is, of course, top of mind for a lot of consumers and certainly for detractors of crypto tech, right? Is there any push to regulate this side of things? We talked about this a little bit before the show.
Sure. So it's a legitimate issue, particularly as we focus more on green economy and things that are protective or sensitive to the environment. There already are in place rules and organizations, government groups like the Department of Energy, the DOE, like the Environmental Protection Agency, that have the ability to step in and look at the issues and potentially regulate the usage of electricity consistent with their mandate, environmental protection and energy conservation. In fact, in the bill, I keep on going back to the bill since it does cover this as well, towards the tail end of this digital commodity bill that I mentioned, there's a direction to the DOE and the EPA that they do this. And the White House, as you mentioned, has also suggested that there's room there for the different regulatory groups to step in and try to make sure that there is sufficient attention paid to the usage of electricity. Mm-hmm. It's a legitimate issue, as an environmental matter. There are, these are fragmented stories, but there are stories about, lakes that are used to cool mining operations going up, going up by 1 or 2 degrees, which hurts the lake and the ecosystem around the lake. And going back to an earlier theme, the idea was that decentralized crypto was a way to support underrepresented minorities, people that tended to be a little less tied into the financial community, perhaps a little less economically well off. Well, there are also stories about how, because of these mining operations, the cost of electricity is going up in communities where the cost is already perhaps prohibitive for the people that crypto are supposed to benefit. So there are real issues here. The question I would ask is not whether or not we shouldn't look at this, but whether or not we're not being broad enough. Because if electricity is an issue and energy is an issue for crypto, well, let's look at the New York Stock Exchange and stocks and bonds that are trading, because I gotta believe there are huge amounts of energy being expended there as well. The only reason I think it's focused on in crypto is because of the mining process and the fact that it uses computers and there's a lot of electricity there. But I gotta believe the energy usage in the more mainstream capital markets is pretty significant as well, and would suggest that that's something that also should be taken a look at.
I like that recommendation. Let's shift gears a little bit. Tell me about your securities law certificate program for the 4 courses. What's your approach, and how does what we covered today kind of fit into the ecosystem of your 4 courses?
Sure. So we talk a little bit in those courses about the Howey analysis and how one might think about it. In fact, I may even talk about pocket full of quarters in that. I can't recall.
Yep.
But we also go through the capital raising process, both the registration process and the exemptions. And the exemptions are key, right? Registration is a process. It's a complicated process. It's a difficult process. But at the end of the day, the idea is to produce information for investors' benefits. Where you can be a rock star is to know the exemptions, because the exemptions will take you out of, not the anti-fraud provisions, right? Anti-fraud is always there, but take you out of that added cost of having to go through the registration process. And so we cover both, and the focus is not just for lawyers, of course, it's for folks who are interested in learning more about the capital markets and how they're regulated.
Perfect. Let's do a lightning round. We got a couple more questions here.
Okay.
Patrick has held on persistently. Is it good for New York State to drive crypto asset industry out of state to Florida and the Caribbean, as it is doing with its only state in the country ban on Bitcoin mining? You know what Patrick's getting at here?
Yeah, so the question is, why would you go ahead and think of the crypto world or the capital markets as a pool of water? Why would you go ahead and try to isolate that small little piece that's New York, because the pool of water is going to still be there? And yeah, I think efforts that are looking to harshly regulate crypto and drive it out of not just New York, but out of the United States, right? That's the other concern, that you're going to regulate it to such an extent that crypto will now all be in Europe, that will now all be in Asia. That's problematic. What it also suggests is a need to have a regulation that is coordinated with other countries and other regulators, so that you don't have these isolated pockets, that you're not, in effect, creating a regulatory arbitrage that benefits Singapore or the Bahamas or wherever, at the expense of the United States. So yeah, this idea of driving something out makes very little sense, but it does suggest the need for greater coordination.
Perfect. Great. Thank you for the viewer questions. You've all been really good. These have been very nuanced and informed questions. Much appreciated. And Chuck, thank you for rolling with the punches with some of these.
No, thanks. These are great questions. You should be in my class.
I know it. I really like what you do, Chuck. Thank you for being here today. Audience, I want you to give us some ratings and feedback if you could. So just hang out for a minute. Shoot the QR code, and we'll ask you to give us a 1 through 5 rating on our show today. And most importantly, feedback. Things that we may have done right in your estimation, things you would have rather seen, shortcomings, whatever, right? I really value your honest feedback so that we can make better shows for you in the future. So open that QR code. Let us know how we did. In the meantime, stay strong, stay safe. Have a great weekend, everyone, and we'll see you on the other side. Thank you so much.
Thank you.